let's imagine that, you decide to start investing in your 20s. And, you go speak to a registered investment advisor or somebody, an investment professional, and they say, hey, listen, for somebody like you, we're really recommending that you be 100% in stocks, or maybe, 80% in stocks, 20% in bonds. And you say, okay, well, that sounds good. And you put your assets in there, and then two things will happen, Rob. One is you're going to get older over time and take on responsibilities, potentially like getting married, like having kids, like having a home. And those can be wonderful decisions. They can also be expensive decisions. And then when you get much older, your investment time horizon decreases. You don't have as much time to make up for investment mistakes. And so a lot of times advisors would recommend going to the perceived safe haven of bonds, and having less equity exposure. Those assets tend to be more volatile. The second thing that will happen is the value of your investments will change around. Over the last however many years, we've seen a generally rising stock market, certainly not all the time, but the market's gone up a lot in the last couple of decades. And so you could have a situation where certain of your assets, certain of your stocks have done really well and become a bigger part of the portfolio.